Okay, let's unpack this. There's one company that seems to be on everyone's mind when we talk about artificial intelligence, a real titan. Nvidia. Today we're taking a deep dive into the latest insights around their upcoming Q2 fiscal 2026 earnings report. That's due August 27th, 2025. We're really going to pull back the curtain on the buzz around their H20 chip, dissect what their guidance means, and, well, try to figure out what it all signifies for the future of the AI revolution. We've been sifting through some fantastic analysis from the Motley Fool to give you the clearest picture we can.
Yeah, and what's truly fascinating here is how NVIDIA's performance, it offers more than just, financial figures. It's really like a critical pulse check on the speed, the scale, and frankly, the direction of the AI revolution itself. Their numbers, and especially their guidance for the next quarter, they aren't just for investors, not at all. They act as these leading indicators, revealing broader market trends, the challenges, the opportunities ahead for this transformative technology. We'll try and connect the dots on how one company's story can tell us so much about an entire industry.
That really sets the stage, doesn't it, why we're digging into Nvidia today. It's not just their balance sheet. It's, like you said, a pulse check on something huge. Yeah. Because, make no mistake, Nvidia isn't just any company. It's considered the ultimate bellwether for the entire AI space. I mean, largest market cap among AI firms, largest stock on the S&P 500 index. So understanding them is understanding a colossal piece of today's tech and, well, the economic landscape too.
Absolutely. Their data center growth, their R&D spend, even just the tone of their management commentary, it all provides these crucial clues about where the AI market is headed.
So you might be wondering then, with all that riding on Nvidia, what are the specific expectations for this upcoming Q2 report? This report, it covers the second quarter of fiscal 2026, which ended July 27, 2025. And here's a really crucial detail right off the bat, one that shapes how we interpret these results. These Q2 figures will not include any H20 chip sales to China.
Right.
That's because U.S. government export controls were firmly in place for the entire reporting period. So that revenue stream, sidelined for this quarter.
That exclusion is indeed a critical detail. It sets a baseline for what to expect. Now, if we look at NVIDIA's own guidance for Q2 fiscal 2026, they projected revenue of $45.0 billion. Which is a staggering 50% year-over-year growth.
50%.
Yeah. Wall Street's consensus estimate, reflecting analyst expectations, it's slightly more optimistic at $46.0 billion. That's forecasting 53% growth.
So huge numbers.
Huge. And for adjusted earnings per share, NVIDIA guided $1.98, signaling 44% growth. Wall Street pegs it slightly higher at $1 a month, representing 48% growth. I mean, for a company of NVIDIA's scale, already a multi-trillion-dollar giant, hitting 50% plus year-over-year growth. It's almost unprecedented.
Right.
It's not just significant, it's really a testament to the, virtually insatiable demand for AI infrastructure right now. It kind of challenges traditional growth models for tech giants and suggests we're still in the very early innings of this AI build-out.
And for you, listening in, as you track these rapid shifts in AI, understanding these numbers isn't just about NVIDIA's financial health. It's about grasping the immense economic forces at play here. NVIDIA's performance, it often reflects the overall health, the investment appetite across the entire AI industry.
Exactly, from cloud providers building out capacity to enterprises eager to deploy AI.
So a strong beat or a miss here could really signal a broader trend. Now here's where we dive into something truly intriguing, almost a paradox. NVIDIA has built this formidable track record of consistently exceeding Wall Street's earnings estimates. Incredibly consistent. But what did that really mean for investors?
It's a remarkable pattern, you could say. Over the last 20 reported quarters, that's 5 solid years of data. NVIDIA has beaten the analyst consensus estimate in, get this, 18 of them.
18 out of 20.
Yeah, a 90% success rate. And the average size of these beats was 11%, ranging from, solid 5% to a whopping 32%. More recently, just looking at the last 4 quarters, they've kept up a 100% beat rate, though the average size has been a bit smaller, averaging 6.9% with a range of 5.3% to 8.5%.
Okay.
This kind of consistency, it suggests either a management team that's incredibly conservative with guidance, maybe setting a low bar they know they can clear, or just, exceptional operational execution in a really dynamic market. Or maybe probably a mix of both.
So, okay, with a track record like that, consistently beating estimates by a healthy margin, you'd naturally think an earnings beat guarantees the stock price goes up, right? I mean, it seems logical. Who wouldn't want to invest in a company that seems to outperform every single quarter? But history, especially with Nvidia, tells a surprisingly nuanced story, often counterintuitive.
Indeed. And this raises a really crucial question for anyone following the market. Why doesn't an earnings beat always translate into an immediate stock price jump? The chart of past performance in our source material is pretty telling. For example, after Q1 fiscal 2026, they had an 8% beat. The stock rose 3.3%. Okay, that fits.
Right, that makes sense.
But contrast that with Q4 fiscal 2025. A very respectable 5% beat led to an 8.5% decline in the stock price the very next day.
An 8.5% decline
Yeah.
after a beat.
Yep.
That really feels counterintuitive. Like, what gives? What complex forces are at play that turn good news into a sell-off?
Well, it highlights that beyond the reported numbers, there's this complex set of expectations and forward-looking sentiment constantly at play. Sometimes Wall Street has what are called whisper numbers, unofficial, often higher estimates circulating privately. An official beat might still fall short of those whispers.
Oh, okay. The unofficial bar.
Exactly. But critically, investors are always pricing in the future. Always. So if current results are strong, but the guidance for the next quarter suggests a slowdown, maybe due to competition, maybe easing demand, maybe a new geopolitical hurdle like we're seeing now, that forward-looking sentiment can just immediately override a good past performance.
So the market's reacting to what will be, not what was.
Precisely.
Yeah.
And of course, broader macroeconomic things, interest rates, trade policies, even a sector rotation out of tech can all influence short-term moves, no matter how strong one company looks. It's a constant reevaluation of that future growth path. Surprises and guidance can be way more impactful than the actual earnings number.
That clarifies it a lot. So it's not just what happened, but critically what's coming next and all those other global factors. And speaking of what's coming next and those geopolitical dynamics you mentioned, our attention immediately turns to the H20 chip for China. Many analysts are calling this the pivotal factor for Nvidia's post-earnings move. This isn't just financials. It's like a geopolitical chessboard playing out in real time. Huge implications for Q3 guidance.
Absolutely. If we connect this to the bigger picture, the H20 chip, it's a data center AI chip. Nvidia specifically designed it to comply with U.S. export control rules for the Chinese market. It represents a strategic effort, really, to keep a foothold in a crucial market while navigating these complex trade policies.
Trying to thread the needle.
Exactly. Earlier this month, the U.S. Commerce Department reportedly started issuing export licenses for these chips. That was seen as a big breakthrough after earlier tougher controls had really hit sales to China hard. Now, in exchange for these licenses, Nvidia reportedly has to pay 15% of H20 revenue to the U.S. government.
15%, wow.
Yeah, it's a fascinating, complex setup. Similar to what AMD struck for its own compliant chips, it effectively turns a slice of the strategic market into direct revenue for the U.S. government.
So for a moment, it seemed like there was a clear path forward. Costly, maybe, but clear. A way to navigate the controls, keep a vital market open. But just when things seemed clearer, a fresh report from Friday, right before this earnings release, threw a massive wrench in the works. The information reported that, and I'm quoting here, Nvidia has told some of its component suppliers to suspend production work related to the H20. And the reason? Reportedly, a recent directive from the Chinese government telling its companies not to buy the chip, citing security concerns.
Oof.
Yeah, really complicates the picture. Adds another layer of geopolitical tension.
And this development is absolutely crucial because Wall Street right now is modeling for Nvidia's Q3 revenue to hit $52.5 billion. That's another 50% year-over-year growth, and adjusted EPS of $1.19, or 47% growth.
Still massive growth projection.
Massive. And those aggressive expectations undoubtedly factor in anticipated H20 sales to China. There's no question. So if this news about the production halt and China's directive proves accurate and persists, it could significantly impact those Q3 projections. It could lead to much lower than expected guidance from Nvidia's management. A big chunk of that $52.5 billion target would suddenly be at risk.
Right, forcing analysts to scramble and recalibrate everything.
Exactly. This is precisely where that forward-looking aspect for investors, the thing we discussed, really kicks in. And it's why Q3 guidance, probably more than the Q2 results themselves, will likely dictate the immediate market reaction. It's just a stark reminder, isn't it? Even the most innovative companies operate within this delicate web of global politics and economic interests.
So putting all these incredibly complex moving parts together, what does this deep dive suggest for you, our listener, someone tracking the industry, about NVIDIA's upcoming report? Sounds like the stage is set for a really complex earnings call.
Well, given NVIDIA's impressive, almost unbelievable track record of beating estimates, A beat on Wall Street's Q2 earnings number seems highly probable. Their operational consistency is just hard to argue with.
Okay.
However, the short-term movement of the stock, that's almost certainly going to hinge on the H20 news and, crucially, what management says about the related Q3 guidance. If the reported halt in H20 production and China's directive are confirmed, and there's no positive update, no path forward presented, meaning if Nvidia basically says, yeah, this revenue stream is off the table for Q3,
Then the stock could drop.
then the stock could decline, or maybe just stay flat, even with a Q2 beat. Conversely, if there's good news on this front, maybe a resolution, a positive shift in the Chinese directive that would likely see the stock gaining significantly, because a major overhang would be lifted. It's just a classic case of future expectations overshadowing past performance.
But for those of us looking beyond the immediate headlines, right, beyond the day-to-day stock swings and the short-term noise,
Yeah.
what's the ultimate takeaway from all this? Is it worth getting caught up in every twist and turn of these intricate stories?
Yeah, that raises an important question that long-term investors wrestle with all the time. Should you focus on the daily stock chart or on the fundamental business thesis? The author of our source material, Beth McKenna, she firmly believes that long-term investors should focus intently on Nvidia's quarterly results, the guidance, the management commentary, but critically, not get caught up in the day-after stock price movement.
Focus on the fundamentals.
Exactly. Nvidia is seen as a multi-year winner because it's AI infrastructure tech, especially its GPUs. It's a fundamental, indispensable enabler of the global AI revolution. It's the picks and shovels of this modern gold rush. This demand isn't fleeting. It's foundational for the next generation of computing. One quarter, even one with tricky geopolitical stuff like the H20 chip, it's just one data point in that much larger multi-year story of innovation and growth. And that story, well, it still seems to have a massive runway ahead.
So you've seen how Nvidia, this true titan of the AI world, is navigating all these complexities, market expectations, its own impressive history, and these potent geopolitical factors impacting crucial products like the H20 chip. We've kind of uncovered why an earnings beat isn't always a straightforward win for the stock price, and how future guidance, shaped by global events, can be the real game changer. It's this dynamic interplay of tech, finance, and international relations that's shaping the future of a whole industry.
You know, the story of Nvidia and its H20 chip, it really does highlight this intricate dance between innovation, global supply chains, and international relations. It makes you wonder, doesn't it? In our increasingly interconnected, maybe even fractured world, how many other seemingly pure tech stories are similarly tangled up with broader economic and political forces? Is the era of truly isolated, purely tech success stories kind of behind us? And what does that mean for how we, as informed observers, should assess the true long-term value and resilience of any major company?
That's a truly fascinating thought to mull over as we all continue to learn and grow. Thank you for joining us on this deep dive.